Hello friends, how are you? Kamasava, Namaste, Adab, Sat Sri Akal, Bonjour. Today's video is an interesting one because it is a continuation of my previous video on investment guide that I did a couple of months ago, and the description is given into the box below the video. The link you can click, or if you subscribe my channel, you can go to my channel and get that video and have a look at that. Today's video is specifically for baby boomers, people who were born between 1946 and 1964, and now they are between the age of 54 to 76 years. One interesting concept is that those baby boomers are about to retire. By 2030, they all will be over 65 years of age. So they all will be looking for some investment strategies where they could maximize their income. And this video suggests that if they invest into mutual funds and ETF, how can they maximize their income? How can they get maximum return on their investment? We all know these baby boomers are about 1.2 billion in the world. US alone, their population is about 73 million. So this is a big population, and this video is useful for these kind of people, and they can look into and decide how to pick an ETF or a mutual fund that would give them a maximum amount of return. Okay, so the difference between mutual fund and ETF is very little. Mutual fund is offered by banks or by other finance companies, but the value of each share of mutual fund is determined at the end of the day because mutual fund is not traded at stock exchange. However, ETF is like trades like a stock where the value changes throughout the day, and in order to buy ETFs, investor has to have a brokerage account. There are 123,000 mutual funds available worldwide. In Canada alone, there are 140 providers who provide about 4,000 funds. Assets under management for mutual funds is close to 1.7 trillion in 2019 in Canada. So mutual funds have lots of variety. But the question is that being an investor, are we allowed, are we able to pick and choose? The answer is yes and no. So why it's no? No is because if being an investor, I go to a bank or a finance company and ask to invest into their mutual fund, so they have only a couple of dozen mutual funds available. And then they asked us to just pick and choose from their own mutual funds. However, if we can open a brokerage account, then situation is different. We can pick and choose among the 123,000 mutual funds through our brokerage account, and we can invest in any mutual fund we like. There are 6,970 exchange traded funds available globally, much lower than the mutual fund. In Canada alone, there are 20 providers and about 480 ETFs available. Assets under management in Canada is close to 120 billion in 2019. But in order to have exchange traded funds or ETFs, the investor has to have a brokerage account because ETFs are offered through brokerage account. So should we go for mutual fund or ETFs? It depends on investors. But there are certain advantages of buying ETFs like low management expense ratio, which is around 0.5 to 0.6%, compared to mutual fund where this MER can go up to 4%, 2 to 4%. So my intention is to earn at least 4 to 7, 8% dividend on my investments. There is a number of screening criteria you can choose and pick. These criteria are also available in many websites You can go to Yahoo Finance or Google Finance, or even if you have brokerage account on their website, this kind of criteria available. So I would like to give you a glimpse of how that criteria look like and what would we do. Yeah, there are possibilities to make extra income from ETFs. How? There are two kinds of ETFs. One is a straight ETF where you buy the fund ETF and then that fund is being invested into different securities and you get dividends from the companies. But there is also a novel type of ETF that is specially for income loving persons. What are those ETFs? Those are called covered call ETFs. Uh, Bank of Montreal in Canada is one of the leading provider of covered call ETFs. What they do is they invest the funds into securities and they do option trading. So option trading gives them an extra premium on their investments. So on top of the regular dividends, the fund earns extra. Cover call option ETF is a good strategy to generate extra premium, about 2 to 3% extra premium. It is a good strategy for additional income, but it has some downsides as well. On the positive side, it provides you more stability during uncertain economic times when the market is in a bearish market, like the market is going down, there's uncertain economic conditions. So option call strategy is a good strategy. But if the market is in recovery mode or there is a strong market upside, then ETF does not have that much of potential to grow. The value of the ETF fund does not grow that much because we call options and those options are mostly matured.
All right,
So
friends. So we need to maximize our income. And now we want to select an ETF or a mutual fund that could give us maximum return on our investment. So criteria we can use, we can go for the country, we decide which country we want to buy. It could be Canada, US, or any other European country, or even China or India. Then we can select and decide what type of mutual fund or ETF we are looking for. Is this a fund that invests with a balanced approach, like investing into high dividend paying companies versus growth companies as well, or we just want a very, very high growth rate for our value of our fund? Definitely for a baby boomer, balanced ETF is better compared to growth ETF or mutual fund. We also look into the funds allocation category, like where what is the investment allocation of the fund, whether the fund invest into equities or into bonds or into commodities, and what is the percentage of each and every category. We also care about management expense ratio. Definitely mutual funds have a very high expense ratio, so ETFs are a good option, and because they offer low MER, but you can check what MER you are comfortable with. You may, if you are comfortable with 2%, you can select 2%, or if you are comfortable with less than 1%, you can select that option as well. You can also select in that screening criteria about the fund family, that who are the providers. For example, in Canada, all commercial banks are the providers of ETF and mutual fund. There are many finance companies who can provide. In a finance company like iShare, Horizon, McKinsey, so you can decide and you can click that provider name to find the ETFs and the mutual funds offered by them. You can also be interested to know how much is the value of the fund. Is it a small fund, like a recently generated fund, a new fund, or it's been in the market for a long time? So if the asset under management is how many, what is the value of the fund? You also can select the inception date, like the date the fund was started. You can select that option as well. You can select distribution yield, like how much dividend it offers you for each unit. Is it 5%, 2%, 6%, 8%? Here, be careful, please, that do not go for a mutual fund or an ETF that offer you double digit yield, because this means that the securities the fund holds are undervalued and they are less possibility that those industries or the companies will grow. So you might lose some money there. So as long as you are below 2 digit, your distribution yield is below 2 digit, you are good to choose. And being a baby boomer, I would go between 6%, 4 to 6% is a safe side of distribution yield. I can also choose the distribution of the dividend. When is that being distributed? Is it monthly or quarterly? If I'm a retired person, I will definitely want something that could give me every month amount of income. So there are ETFs, and most ETFs, which are even option trade, covered call ETFs or straight ETFs or straight mutual funds, there are funds who offer you monthly return. In order to be able to select a good ETF, average trading volume is an important factor, because you don't want to get stuck into an ETF or mutual fund where you want to sell that ETF and there's no buyer. So look at the average trading volume of each of those mutual fund or ETFs. You have to look into the rating and risks. Risk and rating, there's a what is how the fund performs when the market changes. So normally a fund, if it is if there's a 1% decrease in economic conditions and the fund also decreases by 1%, so we call it beta is equal to 1. But if beta is greater than 1, it means that market conditions are going down by 1% and the fund's value is going down by more than 1%, and vice versa. So we have to look into rating and risks of the fund. And of course, you have to look into at least 5 years fund performance. How have the fund performed? How did they change their dividend, or did they increase their dividend? If they've been consistently increasing dividend, means the fund is good. And look at the average price for the ETFs for monthly price, and how for the last 5 years, how have the price changed. Look at the volatility as well. You can select less volatile ETF or mutual fund, or more volatile. So that's also a factor. There are many commission-free ETFs. Those are new, brand new ETFs. I will avoid, being a baby boomer, I will avoid those free ETFs. I would like to give them commission, but I want to pick better ETFs. So this is a basic investment criteria for, normally it applies to everyone. If you are a young person, you would prefer to go for growth ETF or mutual fund. If you are a baby boomer like me, you would prefer to go for the balanced type of ETF or mutual fund. So that's how it works. That's it. Hope you like this video. There's only so much we can give in less than 10 minutes. But thank you very much for watching this video, and please subscribe my channel if you want to know about more videos to come. Press the bell button as well.